I think it's a little of both, Maria. The retail side, they've had a confusing year as you look at what's going on right now. We've seen historical highs on the equities, our fixed income alternative space, not such a great year. So you have those retailers on the sidelines who are wanting to jump in right now and are excited to jump in. They think they might have missed the party. But I would say be very cautious.
Yeah, I mean, we talked to the CEO of Schwab, Nathan, this week, and he basically said, I'm not seeing it. I'm not seeing the individual investor back in this market. What do you think?
I agree with you. I don't see it either. It's not like people are rushing around to go into the stock market. And many of the people who got out of the stock market, which would make a case against timing, have found this an incredibly frustrating 5 years to think about how will I get back in. I think all we saw today in the market, Maria, was that we took a look over in Europe and we went, boy, they're going to give away money. In fact, they're going to lose a little bit of money on each transaction with their new negative interest rates, but they're going to make it up on volume. And I think we decided that's going to be good for U.S. corporations because they're going to get about 20% of our business comes from overseas.
Well, Ron, what do you think? I mean, what's behind this melt-up that we're seeing in stocks? All-time highs tonight. Are you expecting that, sentiment is changing, getting better on the heels of the better-than-expected economic data we've been seeing recently? And, of course, retail catching a real bid.
Right. I think one thing that's not talked about is just the structural benefit that equities have. Share shrinkage is a huge theme that's going on. In the S&P 500, for instance, the total amount of shares outstanding is lower than where it was 10 years ago, and yet we have seen a little bit of demand from institutionals and from retail pick up. We estimate on our model, our quantitative model, that could be responsible for at least 6 to 7% of next year's lift.
Okay, all right. And Brian, in terms of the broad economy right now, what are you seeing? How would you characterize things?
Well, things continue to get gradually better. It's a non-inflationary, lackluster expansion, and I think for a lot of investors that have been looking for the absolutes of good, what they fail to recognize is that as things continue to get better, the stock market can continue to climb higher. We've heard a lot of reasons for the last number of years with regards to the macro picture or regards to the political backdrop of why investors don't want to be in these markets. And quite frankly, it created at times very compelling investment opportunities. So what the market's now reflecting is this has been a normalization to average or slightly above average valuations depending on which metric you look at. But what investors are recognizing is things continue to get modestly better and stocks continue to appear cheap to generally most other asset classes.